There are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. All right, welcome. Today, we're going to tackle a question that, believe it or not, trips up even the most seasoned entrepreneurs. And that is, what exactly counts as business income when it comes to taxes? Now, you might think, hey, that's pretty straightforward, but the official definition is way more specific than you'd imagine. And let me tell you, getting this right is absolutely critical. We're talking about staying compliant and, just as importantly, optimizing your entire financial strategy. Okay, so let's just dive right in. Look, before you can even think about calculating business income, you've got to answer a more fundamental question. Does your activity legally qualify as a business in the first place? Well, thankfully, the courts have given us a pretty clear three-part test to figure that out. And what's so interesting here is how these three things really work together. First, active effort. This means you're not just sitting back collecting rent from a property. That's a whole different category called property income. No, this is about putting in the time and labor. Second, pursuit of profit. This is what separates your actual business from a hobby you just do for fun on weekends. There has to be a genuine intention to make money. And finally, incurring liabilities. This means you are actually on the hook to other people, your customers. You have a responsibility to deliver goods or services. That's a core feature of commerce. So why do we care so much about this distinction? Why does it matter? Well, it all comes down to the bottom line. I mean, how your income gets classified has a direct and often massive impact on how much tax you end up paying. The stakes here are incredibly high. And this chart, this just perfectly illustrates the built-in tension, right? As a taxpayer, your goal is simple. If you have a gain, you want it to be a capital gain because you only pay tax on half of it. But if you have a loss, you definitely want that to be a business loss so you can deduct 100% of it. Now, on the other side of the table, you have the Canada Revenue Agency, the CRA. And what do you think their position is? Yep, the exact opposite. Every time. Their job is to maximize tax revenue. And believe me, this isn't just some academic theory. This is the battleground where major financial disputes happen. Think about real estate. If you flip a couple of houses, is that a capital gain? Or are you now considered to be in the business of selling real estate? The difference in your tax bill can be absolutely enormous. This is exactly why understanding these rules isn't just a good idea, it's completely non-negotiable. All right, let's build on this and move to another absolutely crucial point. So many people fall into this trap. They assume that the profit number they see on their company's income statement, their accounting profit, is the same number they're going to report to the CRA. That is a very, very common and very, very costly mistake. You really need to burn this idea into your brain. For tax purposes, profit does not always equal profit. The Income Tax Act has its own unique, very specific set of rules, and those rules often diverge completely from what we call generally accepted accounting principles, or GAAP. It's like you're playing two different games, each with its own rulebook. And there is no better example of this than the landmark IKEA case. So IKEA gets this huge payment, $1 million, for signing a long-term lease. Now, for their own books, their accounting, they spread that income out over 20 years. Makes sense, right? Well, the Supreme Court said, not so fast. For tax purposes, they ruled that the entire $1 million had to be included as income in the single year they received it. Imagine that. A massive, immediate tax hit they weren't planning for. So that whole situation perfectly leads us to a really unique tax concept, one that just drives home the difference between these two rulebooks. And that is the tax reserve. It's an incredibly powerful tool that really doesn't have a perfect equivalent in the world of standard accounting. So what is it? Just think of a reserve as a temporary, legally allowed deduction. It lets you lower your taxable income for this year. The catch? You have to add that same amount back to your income in the next year. But then you might be able to claim a new reserve, and the cycle continues. Now, there are three common reserves we really need to look at. The first two, for doubtful debts and for unearned revenue, those are going to feel pretty familiar to anyone with an accounting background. But it's this third one, the reserve for unpaid amounts on inventory you've sold. That's the one that's a pure tax planning opportunity. It's got no direct parallel in accounting. Okay, let's walk through a practical example to see how this works. Imagine a landscaping business. They sell some materials for $50,000. Their cost for those materials was $40,000. So the profit's clear, right? Simple math, $10,000. But here's the twist. Look at the payment terms. They only get $30,000 in year 1. The rest comes in year 2 and year 3. Now, from a pure accounting perspective, you'd probably recognize that entire $10,000 profit in year 1 because that's when the sale actually happened. But the tax law asks a different question, right? Can you defer some of that profit since you haven't actually gotten all the cash yet? And this is exactly where that special reserve for unpaid amounts becomes such an incredible tool. The answer is a resounding yes, you absolutely can. And the tax law even gives us a precise formula to use. It's pretty straightforward. You take your gross profit from the sale and you multiply it by a fraction. That fraction is simply the amount of money that's still unpaid at the end of the year divided by the total sale price. So let's plug in the numbers from our landscaping example for year 1. We've got the $10,000 profit. We multiply that by the $20,000 that's still outstanding because they were paid $30,000 of the $50 divided by the total price of $50,000. Do the math, and that gives us a deductible reserve of $4,000. And what's the result? Well, it's huge. The business only has to report and pay tax on $6,000 of profit in year 1, not the full $10,000. They get to defer the tax on that other $4,000. I mean, this is a direct, completely legal way to manage your cash flow by making sure your tax payments are more in line with the cash you actually have in the bank. For a small business, that can be an absolute lifesaver. Okay, so beyond reserves, these differences between the tax world and the accounting world, they are everywhere. And they show up in a big way when we start talking about what you can and what you can't deduct as an expense. Let's just run through some of the most common ones. Meals and entertainment? Your accounting might show the full cost, but for tax, you can only deduct half. Fines and penalties, like a parking ticket you got on a work delivery? Nope, not deductible for tax purposes. And here's a huge one, capital assets. Accounting uses a concept called amortization. The tax world has its own very strict, very different system called capital cost allowance, or CCA. These are not the same thing. What this all means is that every single business essentially has to keep 2 sets of calculations going. You've got one for your financial reporting and a completely separate one for the tax authorities. The real key takeaway is this. Think of your accounting income as the starting line. It's not the finish line. You have to make a whole series of specific adjustments, what we call a reconciliation, to get from that starting point to your final net income for tax purposes. Understanding that duality is it's fundamental to getting this right. So this leaves us with a really important question, one that every business owner needs to think about. Given this deep divide between the tax rules and the accounting rules, are you sure your business is playing by the right playbook? Because in the complex world of tax, it's not just about playing the game well, it's about knowing which game you're even supposed to be playing. And that knowledge, well, that's what determines who wins.